Welcome to Personal Pension Radio Podcast, where you get unconventional insights into retirement and lifestyle design that actually work. You don't have to settle for the same tired Wall Street advice. Break away from the herd and learn how to achieve the retirement lifestyle of your dreams. And now, here's your host, the income engineer, Kraig Strom.
All right, back on Personal Pension Radio. I got to remember to hit that button on my mixing board here. Back on Personal Pension Radio, I am Kraig Strom. I am the income engineer. Glad that you are here once again, episode number 102, broadcasting from the Personal Pension Radio workshop studio here in Southern California. If you haven't been to the website, check out personalpensionradio.com, personalpensionradio.com. That website is going to undergo a major renovation in 2017. But right now, it is still the place to find back episodes, show notes, information links that you might want to have there. If you are looking for show notes for anything that you aren't able to find there, please just send me a message through Personal Pension Radio. And you can also find me on LinkedIn, Facebook, Twitter. You can find me on YouTube with my car shows and things like that. So I'm all over the place. But Personal Pension Radio is an easy way to find me. Now, what is Personal Pension Radio all about? I think it's important that you know that I'm all about income. Obviously, I am the income engineer, whether that is post-retirement income or post-sale of a business income. I'm all about helping people maximize and that optimization of lifestyle income. And I've said it, and I'm going to keep saying it over and over and over again. A product will not fix the income problem. Optimization of retirement income or post-exit lifestyle income does not happen with a product. So mutual funds, life insurance, variable annuities, real estate, guaranteed annuities, bonds, none of those things by themselves will give you truly optimized retirement income. You've got to have an integrated approach that blends the benefits of these things, whether it's real estate and annuities or life insurance and stocks, whatever it is that makes up your wealth. You have to have an integrated approach that takes the benefits of each to enhance the total. Really, that whole adage of stronger together, that it can't be more true when it comes to things like retirement planning. Your investments and your assets are stronger together when they're balanced properly. Now, the challenge that you face out there in the world is that I, as a certified financial planning professional, I was educated by the Wall Street financial advisory machine. And remember, the financial advisory community spends over $7 billion a year just on digital advertising. Just digital advertising. The financial industry spends very little money on financial education, real education. The marketing dollars that are spent are all about save more money, save, 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 invest, invest, invest. How big is your number? That's the pitch. That's what I learned as a young financial advisor, now pushing 17, 18 plus years ago, right? So today, the majority of financial advisors live by that same education. You've got to find a financial advisor that has broken away from the herd, that has continued to expand their education, to expand their knowledge, that will take you, as I will, behind the curtain and teach you things to ask. What about retirement income is different than accumulation and saving for retirement? Because they are very different. The economic rules of accumulation are very different, 180 degrees different than the economic rules of income planning. So please keep that in mind. That's what I'm all about. I'm all about helping you break away from the herd, think differently, ask questions, challenge that marketing machine that is flooding the airwaves and every single website and every single blog post, just flooding it with the same message over and over again. Got to be able to sift through that and ask the right questions. So I hope to inspire you to do that. Now, disclosure, I am not an attorney. I am not a CPA, not a certified public accountant. I am a certified financial planning professional. That doesn't mean that you should act on things that you hear on this show as if they are advice for you and your specific situation. You really need to seek out personalized conversations with, I would hope you would choose a certified financial planner, someone that's really gone that extra mile. And heaven forbid, please do not act on advice that you hear from people like Dave Ramsey or Susie Orman or any of these financial entertainers that are not licensed or regulated. Nobody is watching over the things that these people are saying, and they throw mostly good information on the airwaves, but sometimes, oh my gosh, the information that comes out of these financial entertainers' mouths, it just makes me want to drive my car off the road sometimes. So please, meet with a qualified financial advisor. I would encourage you to think about it this way. Look for a very specific bias. And if you have a hard time trying to figure it out, you're welcome to go to Personal Pension Radio and have a conversation with me. Get in touch. Talk to me and find out whether or not my conversation is different than the conversation that you might have with another financial advisor. But what I'm saying is look for this particular bias. Look for a financial advisor who has a bias in favor of you, the client, that they're going to tell you the ins and outs and pros and cons. They'll tell you what benefits them. They'll tell you what benefits you. And they'll tell you if advice that they might be giving you benefits you and doesn't benefit them, right? So they'll be honest with you and let you know. For example, let me give you a quick example. Someone asked me recently, it was a podcast listener, about financial advice, and they wanted to invest. And I asked the question, why do you want to invest? You know, what's so pressing about it? Well, we got to start saving. We've got to invest. Well, when we dug into everything, bottom line is they did not have their financial house in order. And the smartest thing that I could recommend for them to do was get their insurance protections up to date and correct and maximized. Car insurance and home insurance and umbrella liability insurance and things like that I don't personally do. I was able to help them and direct them with a life insurance discussion. Very basic term life insurance to protect each other, husband and wife, mother and father. And the question came back from this person. She said, well, wait a minute, what's in it for you? I said, well, I guess I will make a small commission. I'll make a small commission helping you with life insurance right now. But right now, there's not much more there that I would recommend that they do with any financial advisor. I did not recommend any investments at this time. I didn't recommend any cash value life insurance at this time. Just good, solid, fundamental, basic protection planning. And then maybe in a year or so, we'll start working on more advanced conversations. But my bias is in favor of that family, that couple, those kids. And I could not, in good conscience, suggest that they purchase, let's say, another financial advisor they had met with suggested that instead of term life insurance, they should buy cash value life insurance. Well, the cash value life insurance was going to give them less than half of the death benefit protection they truly needed for 3 or 4 times the premium. They were going to get nowhere near the basic family protection that they should have had. My suggestion was get the basic term life insurance protection right now, much, much larger death benefit, very low relative premium, and their family is protected, and work on some other good core fundamental things right now. And maybe in a year we can come back and discuss other things like possibly, no certainty here, possibly cash value or investments and things like that, cash value life insurance or investments. But the whole point was my bias was and will always be in favor of that family, that husband and wife, those children. whether it's good for me or not, I've got to stand by that principle. So I encourage you, please, when you're out there talking to a financial advisor, ask these deep questions. Don't be shy. Put them on the spot, okay? Put them on the spot. And remember, look for that integrity and that bias in your favor. If you have any questions whatsoever and you want to test out that same thing that this listener did, this husband and wife did just recently, if you want to test it out, call me. Go to Personal Pension Radio, send me an email. Let's talk. I'll give you my perspective. And if you've got that same kind of conversation and that same perspective coming from the advisor you're already talking with, you're in the right place. You'll have a much better understanding. So please, that offer is open to any listeners who want to do that. Please do that. Now, let's start. Segment 1, watch your step. Okay, watch your step. The financial world is completely biased and focused on accumulation first. And in many cases, financial advisors and just the financial world in general, they are not helping you build your financial house. They're building their own financial house. Okay, so please keep that in mind. So this came to my attention here. Actually, it was a new client introduction recently. And this person came to me, retired. And let me just say, not necessarily retired. They thought they were retired, but as it turns out, they really loved investing still. So they're not running the same business that they used to run, but they are definitely working, but really enjoying the investment side of the world. Now, they have this guy, gentleman, has been very successful, and he was able to save up a substantial amount of money. He actually had over $4 million. He's over 60 years old, still a young guy, over $4 million. And someone very close to him, a family friend, really encouraged him to meet with me. They had already experienced my conversation style and my financial planning style, so they said, hey, Steve, you got to meet with this guy, Kraig. You just got to talk to him. Just give him a try. So Steve, having been working with the same financial advisor for over 20 years and the same CPA for about the same amount of time, he just reluctantly said, okay, right? Now remember, he's worked with a financial advisor for over 20 years. And so I meet with Steve, and I'm changing names to protect the innocent and me. And so I met with him to review his investment portfolio. And I asked kind of my first question. When I looked at this investment portfolio, I was really surprised at how many positions, how many holdings, how many line items were in this portfolio. There were lots and lots and lots of lines and lines and lines of stuff. Various things from stocks and bonds and mutual funds and real estate investment trusts. And there was just tons of stuff. And then there was a whole second account statement that had an entire portfolio of another type of investment that just surprised me. So without making any judgment calls, I just asked, why so many investments in your account? Now remember, 20 years with a financial advisor, 20 years with a financial advisor. And I asked a question that I thought would be, pretty straightforward. Why so many investments in your account? The very first thing he said, diversification. Diversification. I call this the diversification lie, the diversification myth. Anything that I can do to draw your attention to this idea that when you hear the word diversification or diversify your portfolio, please remember this, because diversification only works if you have a group of investments and assets that are not correlated to each other. Correlated means that they move together. When one investment goes up, another goes up. When one goes down, the other goes down. That's correlated. Uncorrelated assets, assets that move in opposite directions or not exactly the same, those are uncorrelated assets. So to really be diversified, you want to have assets that don't all move together in the same direction, up and down and up and down, okay? Because true diversification is not bunches and bunches of different investments. It's investments that move differently, that are going to, one is going to be up while the other might be down, etc. Okay? There's a whole bunch of information out there about diversification, but let me just tell you, standard mutual funds, they provide diversification by their nature. They are a conglomeration of a bunch of different stocks and investments, so you get a bunch of diversification from mutual funds, for example, right? So why have 15 different mutual funds? 15 different mutual funds doesn't necessarily give you more diversification. It basically gives you over diversification, and in many cases, you're spending too much money. So remember, first question was, hey, why do you have so many investments? Diversification. That's what he had been told all these many moons that he's had these investments building and changing and moving. It's because he needs to have diversification. My next question was, are there any other things that you really wanted from these accounts? Anything else that was really important to you in the long run? And the answer was, I used to think I would need income from these accounts, but not anymore. And the answer was not anymore because the investment activity in real estate and other things and business investments after retirement from his previous ownership of a company have actually proven to be very successful, and he doesn't really need any income from these investment accounts because his new investments post-retirement are actually providing him more than enough lifestyle income. So now he looks at these investment accounts and he said to me, well, I used to think that I needed them for income, but I don't anymore. And then he threw this one out. He said, but I do also get a 7% return. I have a 7% guaranteed return on one of these accounts over here. Now, those of you who've listened to my show before, you know that I've talked about these various contracts offered by insurance companies that offer these promotional guaranteed rates of return on certain parts of their contract, like a guaranteed return on an income calculation. But this guy was adamant. He's like, I get a 7% return, right? Well, I had to be the bearer of bad news to let him know that no, you do not get a 7% return. There are no guaranteed 7% returns out there. And if anybody listening has heard they get a guaranteed return on their investment monies at 7%, that is incorrect. There are guaranteed interest rates applied to income riders and income vehicles and various other calculations that they use for calculating a future income or a future benefit, but there is no such thing as a guaranteed 7% return on an accumulation account value. But what this all told me is that this gentleman that I'm meeting with really had no idea kind of what his portfolio was all about. He didn't really understand it. He truly did not understand it. He was really uneducated. And that personally, that is the fault of the advisor. The financial advisor's job is to make sure that the client can actually answer that question intelligently. So it's not that this guy is stupid. Don't think that at all. It's just that he's just unaware of the reality behind his account. So the final question that really helped to set the stage for our ongoing discussions was the one that I asked that kind of really got he really paused, and you could tell he kind of took a swallow and a little step back. He kind of gulped. I said, do you know how much you are paying in fees? And his answer was, not really. I know I'm paying fees, but he didn't really know how much he was paying in fees. So let me tell you how much he's paying in fees. On one of his accounts, now this is the one that was diversified, okay? Diversification, and he was over-diversified, like crazy over-diversified. He's paying $33,000 per year. Now that's 1.5% in a fee. Now, if I am not opposed to charging fees, I am not opposed to earning a living. Don't get me wrong. But my question is, what are you getting for 1.5%. This poor guy didn't understand diversification, had no idea what this 7% return meant. He doesn't need this portfolio for income, and he hasn't needed it for several years now. And yet it's still on track for the same thing that he had started with several years ago, right? So what are you getting for 1.5%? So $33,000 a year on one account, and over, you ready for this, on the second account, now this is the one that he had this guaranteed 7% thing on, $52,000 a year in fees. $52,000 a year in fees. Over $85,000 in fees total between these two accounts. Oh my gosh, he had no idea. Folks, I am encouraging you, I am just pleading with you right now. Ask your financial advisor how much you are paying for your investment portfolios. Ask them. Remember, I am not suggesting whatsoever that your investment advisors and financial planners should work for free. No way. I absolutely believe in earning a good living and giving good service in exchange for the compensation and the fees charged. Totally. But if you're listening to this and you do not truly understand how much your 401k portfolio costs you, what are you doing? You wouldn't just go out and blow money on a car, would you? You'd do some research. Go and research your 401k. Go and research your investment accounts. Ask your financial advisor to give you the details. How much are you paying? Are you paying fees commensurate with perhaps another firm that might charge a different rate? Right? Make sure that you ask those questions. Right? Diversification, if you're hearing that and you're looking at your investments and you've got 20 different line items, ask why. Why do you need so many? Right? Why do you need so much of this or so much of that? So please challenge that. Step out of that line, raise your head up and ask. Remember, you're the one who's responsible for this. You've got to be the one to take action. Okay? So the good news is that this gentleman that I'm talking about is now aware of these things. He is not happy. I will tell you, he's actually kind of riled up. He's a little perturbed, but he now is aware of it. He's woken up. He's like, wow, I had no idea that I was paying that much in fees. I had no idea that I was so over diversified. He'd never even heard that phrase before. Please, you owe it to yourself in the long run. Go and get this done. If you'd like to see how I approach a review like this for you personally, I'm happy to do it. You go to personalpensionradio.com, get in touch with me there. You can find me, Kraig with a K, Strom on LinkedIn. I'm ready to help. Okay, now, listener question, the next section. A listener question. This actually came in. Somebody had heard this. I've talked about it before, but this question came in and they said, I heard you mention the 4 wealth objectives. Would you please go into more detail on those again? Yes, I definitely will. The 4 wealth objectives. Now, this is something I was taught, several years ago. I had heard this in a workshop. I forget where it was. And wow, it just resonated with me. So I have adopted the 4 wealth objectives for years now. It's just a great baseline for making financial decisions. So let's go through this. The first wealth objective is to build and preserve wealth efficiently first. Efficiency first. In the world of financial advice, you've got people always fighting for your attention. You've got one financial advisor says, I can get you 6%. You got another financial advisor who says, no, I can get you 8%. Well, what do? I mean, who wouldn't want to go for the 8%? But my question to you is this. First of all, what is the difference between 6% and 8%? What's the difference between 6% and 8%? Most people blurt out 2%. No, let's get specific. To go from 6% return to 8% return is a 33% increase, right? 33% increase to move from 6% to 8%. So if you get a 33% higher rate of return from one financial advisor, does it make sense that you might have to take more risk to go after that 8%? Probably, right? You might have to get more risk in your portfolio to get a 33% higher rate of return. So when we talk about efficiencies, I talk about it in this phrase, the sniper in the woods. When you think about what's the most dangerous person on the battlefield in so many scenarios, it's the sniper hiding in the woods that you cannot see. And in the financial world, that's hidden fees, taxes, inefficiencies that you're not aware of, okay? When I said earlier how much that gentleman's paying in fees, think about it. That if you're paying 1.5% on $2 million, that's $30,000 a year in fees. But if you could find a financial advisory firm that can do that for 0.95%, less than 1%, which, by the way, completely real, go from 1.5% to 0.95, right? That's $11,000 a year in savings. Just moving from 1.5 to 0.95 is $11,000 a year for that gentleman I mentioned earlier, right? So there's a huge disconnect where we're so focused on rate of return. Which financial advisor is promising me this rate of return or that rate of return? Well, truth be told, you really should be going after the efficiencies first, because they're huge numbers in the long run. Look at that. I mean, if you have $11,000 a year in this guy's case, and you spread that out over 10 years, that is a lot of money that has been recaptured that we can now earn a rate of return on again. So before you go after rate of return, go after the efficiencies first. Find those hidden fees, those taxes, those things that are holding you back, and try to mitigate them or eliminate them. That's first. All right, next, the second wealth objective, plan for maximum enjoyment. Now, this is my favorite. It's probably going to be yours. How will you derive personal enjoyment and satisfaction from your hard work? Okay, certainly the most heavily promoted savings vehicles have often, like 401ks, have very limited enjoyment factors. Very limited enjoyment factor for in a 401k. You basically save for a long time, and then you have to defer that enjoyment of that account, sometimes 20, 30 years. Now, I'm not suggesting at all that 401k is a bad idea. What I am saying, though, is use it as a reference that when we talk about enjoyment from your financial contributions, if you will, into your savings, how are you going to enjoy a 401k? Well, perhaps your 401k allows you to defer paying taxes on $10,000. So maybe you, instead of having to pay taxes, you now have that money available that you can invest in something that might derive personal enjoyment in the years leading up to retirement. Maybe that's investments in real estate. Maybe that's other personal investments. Maybe that's a second home. But if you just simply take the tax savings and you blow it on something that is consumable and disappears, you might enjoy it short term. That can work as well. But just thinking about it from a enjoyment point of view, maybe the tax savings on a 401k, you can put that into your short-term and long-term enjoyment as well. Heavily promoted is mortgages. I've been hearing about this lately because, and I'm sure you have as well, with the fear of interest rates rising, oh, you better refinance your house, refinance to a 15-year or a 20-year mortgage, right? Well, if you think about a 15-year mortgage versus a 30-year mortgage. So, question, if you get a 15-year mortgage, is your house going to be worth the same in 8 years when you sell it, like the average person sells their home every 6, 7, 8 years? If you had a 15-year mortgage versus a 30-year mortgage, isn't your house going to be worth the same 8 years from now when you sell it anyway, right? It is. It's going to be worth the same, but If you had a 15-year mortgage, your mortgage payment could be substantially higher than a 30-year mortgage, and that could cut into your daily, weekly, monthly enjoyment factor, or cut into your ability to invest in other things, right? That if you wanted to invest in other things that might generate additional enjoyment, right? You won't be able to do that in many cases because a 15-year mortgage is a hard commitment. You can't pay a 15-year mortgage like a 30-year mortgage, right? So here's this is a story that I actually heard recently. This was a husband and wife. They had recently moved into their first home. They were sold by the bank basically on a 15-year mortgage because you're going to save so much money in interest on your 15-year mortgage. You should get a 15-year mortgage. Just for the record, think about it. Who really benefits from 15-year mortgages? The bank. Of course, the bank. The bank always benefits themselves, and that's fine. They're in business to make money. So banks sell 15-year mortgages like crazy, as hard as they can, because it's better for the bank. But back to the story. Husband and wife recently moved into their first home, 15-year mortgage. Oh, we're going to be able to pay off our house in 15 years. Well, remember what I said. Most people don't stay in their houses more than 7 or 8 years nowadays. They sell multiple times. Very few people buy their first home that is their forever home. Very few. So here they are, 15-year mortgage. They're pay. And then really right within the first year, the wife got very sick. It was very kind of a mysterious illness, not deathly sick, but just sick, unable to work. And at the same time, the husband was injured just playing recreational soccer, injured badly. Both of them now in a situation where they could not work full time. He was unable to work full time. She was unable to work at all. And they could not afford their 15-year mortgage payment and got foreclosed on. They might have been able to afford a 30-year mortgage, but you cannot pay a 15-year mortgage like a 30. You can pay a 30-year mortgage like a 15-year mortgage, but you can't go the other way. And they got foreclosed on. Way to go, right? That's not enjoyable. Maximum enjoyment is having options. It's being flexible. So in that case, for me, I would have recommended a 30-year mortgage. And if you really insist on paying it off early, go ahead and pay it like a 15-year mortgage. Pay it like a 10, pay it like a 20. You have the flexibility to do that. And if something goes wrong, life goes wrong, you can drop back to a 30-year mortgage. Okay, so you have options. Now, the final two wealth objectives. So we did the first, efficiency first, maximum enjoyment second. Now, the third is plan for maximum legacy. Planning for maximum legacy. Making sure that your wealth goes to the people and causes that you care about, that you choose, and not the government first. Because here's the way most estates, most wealth passes in the United States. If someone dies, husband and wife are gone all of a sudden, an ATM machine pops up in the middle of the living room and a line forms at the machine. And the first entity in line is the government. The government is first, followed by attorneys. We love attorneys. Followed by corporations. And then hospitals and medical facilities. Finally, family and charity in line. Let's think this through. If you had IRAs and 401ks and such, who gets paid first? Always the government. The government always gets their tax money first. If your house had to be sold after you died, escrow has to pay taxes, has to hold money, has to do all that, right? Government gets paid first. That's the way it is, unless you have a plan set up to do it differently. Attorneys can be involved where they have to settle trusts and go through probate because you didn't have your living trust and your will and everything done. Corporations, funeral homes, financial companies, investment management companies. The corporations get paid. Hospitals and medical facilities for end-of-life care and medical bills. Then family, then charity. Proper estate planning means that the family and charity go to the front of the line at that ATM machine, that the people and causes you choose, that you identify, are in front of the government and attorneys and corporations. That's good estate planning. And your ability to leave behind the maximum depends on your planning. And when I say maximum, it's whatever your maximum is, but leave it behind. You have to do it by choice. If you have done none of this, no estate planning, you have made a choice. You have made a choice to let the government, the attorneys, and the corporations and the hospitals stand in line in front of your family and in front of your charities. Please take action on this. Don't let that be your legacy. Now, finally, the fourth wealth objective. Plans must work under most conditions, not just perfect, right? So many times I hear financial advice being given out, like this gentleman I mentioned earlier. He was told he was getting 7%. Yeah, right. That's what he heard. He's getting 7% on some nuance inside of his contract that he didn't understand. But that plan doesn't work under every condition. And in fact, his conditions have changed, and now he's paying huge fees for a plan that's not working, and it's difficult to change. Okay? We want everything to be okay. We want it all to work, but it just doesn't always happen that way. Life goes sideways. Like I said before, a 15-year mortgage cannot be paid like a 30, right? So if you follow wealth objective number 4, that plans must work under most any condition, and a 15-year mortgage works really well if husband and wife both have a job, well, what if wife doesn't have a job all of a sudden? Well, then a 15-year mortgage can cause a serious problem, right? So a 30-year mortgage would mean that the plan would work under most any condition, you see. So making sure you're looking at that. How about the push for maximum retirement savings without a liquidity plan? The mantra from Wall Street is save, invest, max out your 401k, max out your IRA, max out your Roth. Well, what good is all of that if you don't have strong liquidity, if you don't have cash on hand that you can get to without tax penalties, right? Poor protection is the one I'm going to finish with. Plans have to work under most any condition. You cannot be going through life with a financial plan that doesn't have a fence around it, that doesn't have protection. I meet people, for example, just recently, met a gentleman, it's not a gentleman, he is a gentleman, but a friend of mine who runs a multi-million-dollar company. And I asked him, because he's a friend, I said, so who do you have your umbrella liability insurance through? And he says, what is that? He didn't even know what it was. He's got a multi-million-dollar company, and he doesn't even have personal umbrella liability insurance on his homeowner's policy. That covers you as a big umbrella. A multi-million-dollar policy is so inexpensive. He didn't have it, right? So I told him, I said, look, if you ran over somebody at the grocery store, they're going to hire an attorney, and the attorney's going to find out that you're the CEO of a multi-million-dollar company, and that attorney is going to go hardcore into court suing you. They're going to sue you for everything they possibly can, right? Of course. An umbrella liability insurance policy, though, would most likely make any kind of a lawsuit like that go away very quickly. So make sure you're protected. How about disability income insurance? This is a big one for me. I don't talk about it enough, and I'm going to definitely do that. Disability income insurance. This is paycheck insurance, right? We insure our cars. We insure our homes. We insure medical insurance. We insure our pets, right? We insure everything but the paycheck that pays for all of it. So for crying out loud, if you have never gotten a quote or talked to someone about disability insurance, go to Personal Pension Radio and do that one thing for sure. I love helping people with disability income planning, okay? Now, last one, not enough life insurance, right? Here's the thing. I want to ask you this question, okay? if something happened to your spouse, do you want your kids and your family to accomplish the things that you would ultimately plan to do together, right? Do you want them to go to college? Do you want them to go on a church mission? Do you want them to have those benefits? Okay, yes. I don't know too many people that say, nah, I don't care, I'm dead. No, you say absolutely. If you could choose to make sure that what you were building and hoping for as a couple happens, why not leave behind the financial resources to make it happen? Why not leave behind the financial resources to make sure that your kids can go to college, to make sure that they can go on a church mission if they wanted to make sure that the mortgage is paid off, to make sure that your wife or your husband could stay home with your young children without having to go back to work so that they can raise them, so they're not raised by nannies and preschools, right? Life insurance, it's economic life value. It's helping you accomplish the things that you wanted to do together, but you may not have been able to stick around for. So umbrella liability insurance, disability income insurance, life insurance, car insurance, home insurance, protection first before you let somebody start selling you investments. If you're not properly protected, the investments can easily be accessed through lawsuit. So please, you owe it to yourself. Make sure that your plan works under most any condition. And then the third wealth objective was planning for maximum legacy. Put your family and your charities at the front of that ATM machine line. The second one, plan for maximum enjoyment. How will you be able to truly enjoy your wealth and all of your hard work? Okay. And then first, start with efficiency in mind first. Efficiency first. Remember that 6% to 8% is a 33% increase. That's a huge jump. Look for the sniper in the woods. Call your financial advisor. Ask them to detail every single fee and expense that they can find in your account. And if you're not certain that you're getting a straight shot answer, go to Personal Pension Radio. I will be happy to go through and give you a portfolio audit. You have got to see the portfolio audit that I do and the conversation that I have with it. And you're welcome to take it back to your own financial advisor, but I'm happy to help. And that wraps it up for today. Please remember, Christmas is coming right up here on us. It is a fantastic time of year. You got family around. Have those conversations, talk to people, make sure that you're taking action on things. Don't get lost in the holidays and New Year's resolutions coming up. Remember, the future belongs to those who take action. Get off the log. Get off the log. Remember the 4 frogs on the log. 3 frogs decide to jump. How many frogs are left? All 4 frogs are still on the log because the 3 of them only decided to jump. Take action. Get off the log. Get your financial house in order, and I'm here to help. Please use me as a resource. Go to personalpensionradio.com. Check out the show notes, but contact me. Ask me questions. I love all the questions that come in. Really do appreciate it. I'll talk to you again soon. Take care.
Thank you for listening to the Personal Pension Radio podcast. We took notes for you, so if you missed any part of the show, you can find a full transcript of each episode at personalpensionradio.com. Be sure to download your free retirement income crisis report at personalpensionradio.com. While you're at it, we would appreciate some iTunes love. Please leave us a fantastic rating on iTunes by going to personalpensionradio.com/iTunes. Thanks again for listening. Now for the disclosure. Information presented is for educational purposes only and is not intended for solicitation, sale or purchase of any security or financial product. Be sure to first consult with a qualified financial advisor and your tax professional before implementing any strategy discussed here. The term personal pension refers to a marketing name designed to educate future retirees and retirees about the economic principles behind creating their own pension-like income. The term personal pension is not intended to be confused with a defined benefit pension plan offered by an employer or by a government entity.